Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth Managers, and a lot of you have been having me look at your target date funds. Did I say that sentence correctly? A lot of you have had me looking at your target date funds. You see, at Jazz Wealth, all of our clients, I will review your 401k, any outside investments that you have, while we're managing your Roth IRA or any other investments that we are managing. And so it's one of the services that we offer. It's completely included. I like to make sure that you're invested properly at your workplace retirement plan because nobody helps you with that, not even the 401k provider. But I also like to see, are there any other options? Meaning, can we get you the same investment profile but save you some money? Are those mutual funds a little cheaper? Are there some other ones that we could choose from? Well, a lot of times what I find is that you guys chose the target date funds. And do you know why the target date fund is put right in front of you and said, here, take the target date fund, don't choose anything else, take target date fund? You ever wonder why that is? Well, a while ago, it was ruled that target date funds could fall under what is called a safe harbor provision, which in short just means that if you choose the target date fund, no matter what they do with the investments inside the target date fund, you cannot blame the 401k provider. Now, we did a video on Fidelity just a little bit ago of how they're taking excessive risk in the target date fund, and a lot of you said, hey, what's my recourse here? If the markets fall and they're taking excessive risk and I end up getting hurt, what's my recourse? Nothing. There's nothing you can do about it because it's been ruled that that falls under safe harbor, which means you chose it, you accept the risk and limitations, and they are under no obligation to stop you from taking too much risk. Wells Fargo, also one you might want to look at if you have a target date fund with them. Well, here's what we did. We went and we looked at the top target date funds that are out there. And we wanted to see how are they investing at the different points in your life. See, a target date fund, if you're investing and you have 30 years left to retirement, then there should be an aggressive stock allocation versus a bond allocation. And the closer you get to retirement, the less risk you should take. And then when you get into retirement, ideally you should be playing it sort of safe. Now there's, the definition of what that means is somewhat flexible, but we wanted to take a look and see. And so I went to Morningstar. Now, I don't actually subscribe to Morningstar, so I can't get the actual details here, but here's a graph of the top target date funds, which I promise you probably have in your 401k, and here is how they break down as far as the risk that they take and when they take that risk relative to your retirement. All right, so if you take a look at that middle line, that is the date of your retirement. That is the target date of the fund. Now, everything to the left of this is going to be prior to retirement. So take a look at the bottom and you see it starts with 50 years and goes all the way to the target date. Now that would mean that you have 50 years until retirement. Now if you go from the far left all the way to the top, you can see that if you have 50 years left to retire, you should be taking a pretty extreme growth approach. You should be taking risk, and you can see that on the charts, as they're taking mostly 100% risk with your investments in individual stocks or ETFs, things like that. So that's the first part. Now, as you get closer to the target date, you're seeing that it starts to slide down. Here's the big difference. This is where people start to wonder, why is my target date fund not doing well? Well, if you look at the chart and you see those first few lines, the red ones, the yellow ones, the green one, look at how fast they're tapering off your risk, meaning they're starting to play it safer, and you still have 20, 15, 10 years left until you retire, which means that portion of your lifespan, your investment lifespan, is going to underperform. You don't want to underperform. You want every last penny you can get while you still have 20 years left to retirement. At 20 years left to retirement, you can afford for the markets to collapse, collapse, and recover again. So it's safe to say you should still be taking a decent amount of risk. Now, as you go up, you start to see some of the funds that keep that risk pretty aggressive. And that's fair. That's where you want to land. When you have 20, 15, 10 years left to retire, you can afford to take a little bit more risk. So that's the first part that I want to bring your attention to. And you really should look at how the target date fund has planned to take the risk. Now, of course, that can change, But for now, when you sign up for one, you want to know that they're taking an appropriate amount of risk, which leads us to the second part of this story here. Let's go back to the chart and look to the right of the target date line. So what that means is basically you have now retired. You have gotten to a point where you've decided that you're going to start taking money out. That is your projected retirement date. Now, look at how much separation there is between the least aggressive funds and the most aggressive funds. If we look at everything to the right, you can see that there are a handful of funds that are still close to 60% invested in the stock market. Not only that, do you see how it flatlines there? That means that they're consistently keeping you at 50-50, meaning 50% in the stock market, 50% in bonds, all the way through your retirement. In my opinion, that's way too much risk. If the market falls 20, 30, 40%, you're going to get about 50% of that, and that's if bonds don't kick in to save you on the back end. So take a look at the chart there at the funds that are at the top end of the risk spectrum. Now, in the same respect, there's some that are at the very bottom of the risk spectrum where, that's probably fair. These guys are saying, we want to play it safe. You've worked hard. We're playing it safe. And actually, if you move back to the left of the target date line, you can see that these are the funds that play it safe in general. These are your Vanguard funds. When in doubt, they're going to play it safe. They don't want to take excess risk. They want the name, the stability of their name to sort of, win over all things else considered. So going back to the chart there, anything that's taking 40% and above risk with your retirement investments, 10 years into retirement, do the math there, you're like 77 years old. You can't afford to be losing 40% of your account or seeing a severe drawdown in 40% of your account. So that's very important that you take a look at your individual target date fund and how do they plan on investing for you. If it's a Fidelity Freedom Fund or something at Wells Fargo as of late, we now know that they're taking excessive risk with your retirement. You may want to look a little closer. If it's something like the Vanguard funds, then you may not be taking enough risk. I can't say enough good things about them. Of course, I use a lot of their exchange-traded funds when it comes to us investing. But look, saving money on fees can't be the only thing here. If you have a Vanguard fund and you're like, I love these guys, I'm working with them, everything's cool, just make sure it's performing in line with your expectations. Because even though you might be saving 0.004% on your fund thinking you're getting a great deal, you might be underperforming what you should be doing, and that maybe you're underperforming by 2, 3, or 4%. Well, that adds up and we hate to see that. So when in doubt, I'm not saying you should pay excessive fees, but there may be a better alternative. All right, bit of a long video there. I hope this helps. Let me know in the comments section below if you even know how to look up how your target date fund invests for you. If you need help, of course, jazzwealth.com. We help all of our clients with that. If you're thinking about moving to Jazz Wealth, just go to jazzwealth.com, click Invest Now, or click Chat with Jazz. I will literally be the guy to call you and answer all your questions.
Take it, Satch.